Hey, this is Kim Kleiman from SteadyOptions.com. I would like to talk today about one specific trade that was recommended by one of the options advisories that I follow. As an options trader, I follow few traders and few options advisories. I think it's important to see what the other traders are doing, to learn some things, maybe even to take some things and to implement in your own trading. This specific trade, I would definitely not implement in my own trading and would not recommend for you to do. So this specific trade was referring to Netflix. Netflix was going to announce earnings on April 16, 2015. The trade that was recommended was an iron condor on weekly options expiring in 2 days. And the trade was selling 520 calls, buying 522.5 calls, selling 427.5 puts, and buying 425 puts. Now this is iron condor, and if you're not familiar with iron condor, it's basically a neutral strategy, a neutral option strategy. And the rationale is that the stock should remain in the range between the calls that we sell and the puts that we sell. And in this case, the calls that we sell are around 9% distance from the current price, and the puts are around 10% distance from the current price. And if indeed the stock remains in this range, the trade is expected to make around 60% because all options will expire worthless, and we are basically keeping all the credit, which is $90. So this is the rationale that they described when sending the trade alert. Volatility is elevated in the April options, which makes this trade attractive. The IV percentile rank is elevated at 73%, which also gives us a good opportunity to sell this iron condor. We expect volatility to fall sharply after earnings, which will contract the value of this short-term neutral position. Probability, there is 80% probability that Netflix shares will be below the 520 level and 80% probability that it will be above 427.5 level at April expiration. This trade offers a good risk-reward scenario with the amount of credit collected versus probability numbers for this position. And they continue, describe trade duration. We have 2 days to April expiration. And the logic, we want to take advantage of the increased volatility, in our opinion, by initiating this earnings play. Our short verticals are outside of anticipated one standard deviation move that the options are pricing in, so our probabilities are positive. The shares will hopefully remain between our short verticals, and we will be aggressive in closing the trade. So far, so good. Now, my comments. It is true that volatility is elevated in the April options, but this is completely normal considering the upcoming earnings and does not make the trade attractive by itself. Netflix has a history of very big post-earnings moves, and this is why the options are so elevated. Now, it is also true that volatility will fall sharply after earnings. And if it does, and the price doesn't move and stays in the range, then volatility collapse will definitely play into our probability, so the trade will probably make money. However, it is not relevant if the stock will be trading above the long strikes. In this case, the trade will still lose 100%. Now, trade duration is only 2 days. We have only 2 days to April expiration, and it makes the trade even more risky because there will be no time to adjust to take any corrective actions if the stock goes outside our profitability range. 80% probability that Netflix shares will be below 520 levels. Again, it means nothing when earnings are involved. Probabilities are correct and should be taken into consideration in normal trades, but not in earnings trades, because in earnings trades, everything could happen, and probabilities are basically don't mean much. And the price action of this trade will be determined by earnings only, not by options probabilities. Now I like this one. The shares will hopefully remain between our short verticals. What can I say? To me, hope is not a strategy. Now, if you look at the trade, the short strikes are less than 10% from the stock price, which is not fair enough, considering Netflix earnings history. And speaking of Netflix earnings history, let's take a look. So I'm looking at the option SLAM that presents earnings history along with the results of a straddle initiated 1 day before earnings. So they did it in the April cycle. So looking at previous cycle, a January cycle, the stock moved almost 19%. Cycle before, it moved 26%. Couple of cycles before, it moved 18%. So this is pretty big history of moves. And again, they initiated Iron Condor, which has short strikes less than 10% from the stock. And I'm asking a simple question. Who in his right mind would do that on a stock that has tendency to move 15, 20, or even 25% after earnings on a regular basis? I just don't see an edge here. So let's see what happened the next day. So the next day, the stock is up 13% and is trading at 537. And 537 is well below both the short and the long strikes of the calls. Now it is true that the puts will expire worthless, probably. But the calls are deeply in the money, and we're looking at almost 100% loss. And this is expected to happen if the stock moves outside the profitability range. Now, it is true that implied volatility is down, but it doesn't really help us because, again, the stock is well above both short and long strike, and this vertical is basically losing almost 100%. So, that said, I'm not completely dismissing trading iron condors for earnings. For many stocks, options consistently overestimate the expected move. So on average, options actually tend to be overpriced before earnings, which means that selling them might actually have an edge, assuming, of course, that you have a proper position sizing and still are ready to lose 100%. But speaking of Netflix, Netflix is one of the worst stocks to use for this strategy, considering its earning history. And if we go back to earnings history and take a look at the profitability of a straddle initiated 1 day before earnings, we can see that in many cases, straddle was actually very profitable. which means that for stock like Netflix, it actually makes sense to buy options before earnings, not to sell them. In steady options, we are not holding our trades through earnings because to me, it is just too risky and too unpredictable. We implement a number of strategies like straddles and calendars, but what we do, we usually buy our trades about a week or 2 weeks before earnings, and we always sell a day or two before earnings are announced. Again, because earnings are so unpredictable and the risk is too high. So that's it for today. Thank you for watching and have a good day.